Imagine that you've just hit $100,000 in your dividend portfolio. Suddenly, something magical happens. Your monthly dividend checks start growing faster than ever before. That passive income stream isn't just trickling anymore, it's flowing. Well, let me show you exactly how to get there, even if you're starting from zero today. You know what's interesting about the $100,000 mark? It's not just a random number. It's what I call the dividend acceleration point. Let me explain why this matters so much. Imagine you're pushing a heavy boulder up a hill. Those first few yards, they're brutal. That's exactly what building your first $100,000 feels like. It's a grind. You're saving every dollar, reinvesting every dividend, and sometimes it feels like you're barely making progress. But here's where it gets exciting. Once you hit that $100,000 summit, something incredible happens. That boulder you've been pushing, it starts rolling down the other side of the hill, picking up speed on its own. That's exactly what happens to your dividend income after $100,000. Let's break down exactly why your dividend income explodes after hitting $100,000. There are three powerful forces at work here. At the top is the power of scale. Think about this. If you have $10,000 invested in dividend stocks yielding 4%, you're making $400 a year in dividends. Not life-changing money, right? But with $100,000, now you're looking at $4,000 a year. That's $333 every single month, passively hitting your account. But that $4,000 isn't just sitting there. When reinvested, it's buying you more dividend-paying shares every single month. And those new shares, they're paying dividends too. This leads us to our second force. Then comes the compounding avalanche, which accelerates your dividend. At $100,000, your compounding starts to create what I call the dividend avalanche effect. Let's look at a real example. Imagine you've invested $100,000 in a portfolio of dividend aristocrats with an average yield of 4% and a dividend growth rate of 6% annually. In your first year, you're earning $4,000 in dividends. But by reinvesting these dividends, you're not just getting the 6% dividend growth from your existing shares. You're also buying approximately 100 new shares each year, assuming an average $40 stock price. These new shares start paying dividends too, creating a powerful snowball effect. By year 5, your annual dividend income isn't just $5,052, what it would be with simple 6% growth. It's closer to $6,000 because of all those extra shares you've accumulated. Finally, we have the institutional advantage. Here's something most investors don't realize about hitting the $100,000 mark. You start playing in a different league. With $100,000, you suddenly have access to opportunities that weren't available before. Many premium dividend funds have minimum investment requirements of $50,000 or $100,000. These funds often offer higher yields and lower fees compared to their retail counterparts. Not only that, but at $100,000, you can start diversifying across different types of dividend investments. Blue chip dividend stocks, real estate investment trusts, REITs, preferred stocks, international dividend payers, and high-yield corporate bonds. This diversification doesn't just protect your wealth, it accelerates it. The ability to spread your investments across multiple dividend-generating assets creates a more resilient portfolio that can weather market volatility while maintaining consistent income growth. When one sector faces challenges, others may thrive, ensuring your dividend stream remains stable and continues to compound over time. But wait, there's more happening at $100,000 that most people don't talk about. Let me share 3 hidden benefits that kick in. First, you'll experience significantly lower trading costs. When you're working with larger sums, your percentage cost drop dramatically. Think about it. A $7 trading fee on a $1,000 investment eats up 0.7% of your investment right from the start. But when you're making a $10,000 investment, that same $7 fee is just 0.07%. This means more of your money stays invested and working for you, accelerating your wealth building journey. The second hidden benefit is better tax efficiency. With $100,000 in your portfolio, you can implement more sophisticated tax strategies that simply aren't practical with smaller amounts. You gain the flexibility to balance high-yield investments in tax-advantaged accounts while keeping qualified dividend payers in taxable accounts. This kind of tax optimization isn't just about saving a few dollars. It can save you thousands in taxes each year, effectively supercharging your returns. Finally, there's the power of position sizing. Having $100,000 opens up entirely new possibilities for portfolio construction. Instead of being forced to go all in on just one or two stocks, you can properly diversify across 20 to 30 positions while still maintaining meaningful position sizes. This level of diversification not only reduces your risk, but also allows you to take advantage of more opportunities in the market without overexposing yourself to any single investment. Let me show you exactly how this acceleration works in real numbers, using a real example with conservative estimates. Starting with a $100,000 portfolio, your journey begins with $4,000 in dividends in your first year, based on a modest 4% yield. As you move into the second year, thanks to reinvested dividends and a 6% dividend growth rate, your annual income jumps to $4,420. This upward trend continues steadily, reaching $4,905 in year 3, climbing to $5,469 by year 4, and hitting an impressive $6,127 by year 5. Now, here's where it gets really interesting. By the time you reach year 5, your initial $100,000 portfolio has likely grown to approximately $134,000. And that's with relatively conservative assumptions of 6% appreciation plus reinvested dividends. This growth milestone is particularly significant because you're now generating more in dividend income each year than you probably managed to save in entire years during your journey to your first $100,000. It's a powerful illustration of how your money starts working harder than you do once you reach that crucial $100,000 threshold. The income acceleration becomes self-sustaining, creating a virtuous cycle of growth that continues to build upon itself year after year. Now that you understand why $100,000 is such a critical milestone, let's discuss how to get there as quickly as possible. I'm going to share 5 proven strategies that can accelerate your journey, each designed to maximize your potential for reaching this crucial threshold. Strategy number 1, the dividend ladder approach. The dividend ladder approach is a sophisticated method of building your portfolio that balances immediate income with long-term growth potential. Instead of chasing the highest yields, which can often be a dangerous trap, you'll create a carefully structured ladder. Start by allocating 40% of your portfolio to stable, low-yield dividend growers yielding 2 to 3%. These are companies like Microsoft, Apple, or Nike, businesses with strong fundamentals and consistent dividend growth. The next 40% goes to medium-yield established companies paying 4 to 5%, such as Coca-Cola or Johnson & Johnson. Finally, place the remaining 20% in high-yield investments offering 6% or more, such as select REITs or utility companies. This balanced approach ensures you're not just maximizing current income, but building a foundation for future growth, as the lower-yielding stocks increase their dividends over time, effectively becoming your future high yielders. Strategy number 2, the income multiplier method. This is my favorite strategy for accelerating your path to $100,000, and for good reason. The income multiplier method works by creating multiple streams of income specifically dedicated to dividend investing. Start with your primary job income as your foundation. Then add a side hustle that aligns with your skills and schedule. This could be freelancing, consulting, or even a part-time job in your field of expertise. The key is to direct 100% of this additional income into your dividend portfolio. For instance, if you can generate just $500 monthly through these side activities, that's $6,000 annually going straight into dividend-paying stocks. When combined with regular contributions from your main income, you're not just adding more capital, you're significantly compressing your timeline to reach $100,000 through accelerated investments. Strategy number 3, the reinvestment accelerator. This strategy might seem simple, but it's where many investors stumble due to impatience. The reinvestment accelerator requires strict discipline. Every single dollar of dividends must be automatically reinvested, especially before hitting that crucial $100,000 mark. Here's the power of this approach. If you're earning $2,000 in annual dividends, reinvesting means you're not just receiving that income, you're automatically purchasing more dividend-paying shares every quarter. This creates a compounding effect where each reinvestment increases your future dividend payments, accelerating your journey toward $100,000. Think of it as a snowball rolling downhill, gathering more snow, dividends, as it grows larger. Strategy number 4, strategic sector allocation. Strategic sector allocation is crucial for maximizing both growth and stability on your path to $100,000. I recommend a carefully balanced approach. Allocate 30% to financial services, including banks and insurance companies, which tend to increase dividends as interest rates rise. Put 25% in consumer staples, providing stability through economic cycles. Dedicate 20% to healthcare, benefiting from demographic trends and consistent demand. Place 15% in utilities for steady, regulated returns, and invest 10% in technology for growth potential. This diversified mix provides defensive positioning while maintaining growth opportunities, creating a robust foundation for your dividend portfolio. Strategy number 5, the cost averaging maximizer. A new strategy complements the others perfectly. The cost averaging maximizer. This approach involves systematically investing a fixed amount at regular intervals, regardless of market conditions. But here's the twist. Increase your regular investment amount by 1% every month. Starting with $500 monthly, you'd invest $505 the next month, then $510.05, and so on. This subtle increase is usually barely noticeable in your monthly budget, but can significantly accelerate your journey to $100,000. Additionally, set up trigger points where you invest more aggressively during market corrections when stocks are essentially on sale. This strategy helps you build your position steadily while taking advantage of market volatility. Each of these strategies works well independently, but when combined, they create a powerful system for reaching your $100,000 goal. The key is to implement them systematically and stick to your plan, even when markets become volatile. Remember, reaching $100,000 isn't just about the destination, it's about building the right habits and systems that will serve you well beyond this milestone. Before we dive into our final thoughts, I want to address some critical pitfalls that often derail investors on their journey to $100,000. The first and perhaps most dangerous mistake is yield chasing. It's tempting to load up on stocks offering those mouth-watering 12% yields, but remember, if something seems too good to be true, it usually is. Instead of gambling on unsustainable high yields, focus your strategy on companies offering moderate yields between 3 to 6% that have demonstrated consistent dividend growth over time. This leads to another common mistake: lack of patience. Many investors get discouraged when they don't see explosive growth right away, not realizing that building to $100,000 is more like a marathon than a sprint. The initial phase is about building a solid foundation that will support explosive growth later. Think of it as laying the groundwork for your future wealth-building machine. Finally, one mistake that can seriously impede your progress is poor position sizing. Even if you're absolutely convinced about a company's potential, never allocate more than 5% of your portfolio to any single stock. Diversification isn't just a fancy investment term. It's your safety net on the road to $100,000, protecting you from company-specific risks that could derail your progress. So what's your next move? Are you ready to start your journey to $100,000? Drop a comment below with your biggest takeaway from this video. And if you're serious about building dividend wealth, hit that subscribe button and notification bell. I release new dividend strategies every week to help you reach financial freedom faster. Remember, the best time to plant a new tree was 20 years ago. The second best time is today. The same goes for dividend investing. Start now, stay consistent, and watch your wealth explode after that crucial $100,000 milestone.